Welcome back to Griffonomics, where we conduct financial investigations to define the risk before we look at the reward. Today we're diving into Rekor Systems, Inc., REKR.
Oh, this is a fascinating one.
It really is. It's an AI-driven roadway intelligence company that seems to be sitting right at the intersection of, well, infrastructure modernization and some pretty profound financial risks.
Absolutely. And for this deep dive, we've synthesized, a whole stack of detailed sources. We've got their recent Q3 2025 10Q filing, which is critical.
Right, and we've also pulled in strategic analysis from analysts, details on some of their potentially company-making landmark contracts. We're really trying to figure out what's actually happening here.
So if we boil it all down, our thesis for you today is really a two-part story. First, Rekor is undergoing this incredibly high-stakes pivot. They're trying to shift from being a low-margin, kind of one-off project provider
to a scalable data as a service, a DaaS platform. And the second part of that is the bet. They are betting that their huge wins, like the $50 million minimum GDOT contract and that record 63.4% adjusted gross margin,
are going to be enough to overcome, a pretty difficult history of negative cash flow. And of course, the big one, the explicit going concern warning that's disclosed right there in its Q3 2025 filings.
That thesis captures the core conflict perfectly. I mean, that conflict, that juxtaposition of phenomenal operational success against an almost existential financial risk, is exactly why this company is one of the most volatile and, frankly, most fascinating case studies in the AI infrastructure space right now.
It really is. And for you, the listener, this deep dive is all about assessing whether management's strategic pivot has delivered enough tangible results and quickly enough to escape the financial gravity well they've been stuck in.
So we have to look closely at that Q3 data.
We have to. It's where management has basically planted their flag and claimed an inflection point occurred.
Okay, let's unpack this financial pivot first, because the Q3 2025 results for the period ending September 30th, they really do suggest something fundamentally changed from that old legacy project-based model.
The top-line story, right off the bat, it was exactly the kind of evidence the bulls were waiting for.
Let's get into the numbers. Total revenue reached a record quarterly high of $14.194 million.
And you have to put that number in perspective. That's a significant 35% increase year over year.
35% compared to what, about $10.5 million in Q3 of 2024?
Exactly, $10.546 million. So this isn't just, some minor organic growth. This is clear evidence that management is successfully bidding on and, more importantly, executing on larger, higher value contracts.
That 35% jump is crucial, not just for the revenue line itself, but because it really validates that strategic shift away from the smaller, more volatile hardware installation jobs they used to do.
Right. And what's even more indicative of this new DaaS strategy really gaining momentum is the recurring revenue metric.
I was just about to ask about that, because total revenue is one thing, but the quality of that revenue is another.
That's the whole ballgame. Recurring revenue for the quarter increased a really solid 18% to $6.520 million.
Okay, so a little over $6.5 million in recurring revenue?
Yes, and that is the sustainable, predictable, bread and butter income stream they absolutely need to build their long-term valuation on. It's the sticky revenue.
So when you see that big jump in total revenue happening alongside a healthy, 18% increase in recurring subscription sales, it basically confirms the strategic engine is finally catching traction.
It's firing on more than one cylinder, finally.
But here's where it gets really interesting, and I think this is where the entire valuation narrative could fundamentally change the margin transformation.
This is it. This is the financial proof that the DaaS pivot isn't just about growing revenue, it's about the quality of that income.
So what did we see? We saw the adjusted gross margin soar to a record 63.4% in Q3 2025.
That number is just staggering when you look at where they came from. It's a dramatic increase from 44.0% in the prior year period.
44%. And if you recall, their margins dipped as low as 49.5% in just the prior quarter, Q2, because they were so reliant on those low-margin hardware and service contracts. That was the old model.
A gross margin getting over 63% is, I think, the single most compelling piece of evidence supporting the entire DaaS's investment thesis.
Let's put that in context for our listeners. Why is a number like 63.4% so important for a company like this?
Well, think about where this company operates. You have traditional infrastructure and hardware vendors, right? They often struggle to hit gross margins much above, say, 30 or 40%.
Okay, so that's the low end.
Then on the other end, you have pure software companies, true SaaS models. They're aiming for 70 to 80% gross margins.
And Rekor hitting 63.4% puts them where exactly?
It means they're successfully operating in that sweet spot, right between a pure software play and a physical infrastructure provider. And they even confirmed it in the filing. This expansion is directly correlated to a favorable mix of software sales versus service-type work and higher perpetual license sales.
So they're literally proving the model. They are successfully converting that volatile, low-margin project work into highly predictable, high-margin software territory.
Which is the very definition of achieving operating leverage. It's what every company in this position dreams of doing.
Absolutely. But, that margin expansion alone is meaningless if you're still just burning money on the operational side, which, let's be honest, was their historical weakness.
A huge weakness. But the sources show management executed these aggressive cost containment initiatives with really remarkable success.
Let's see the numbers on that. We saw total operating expenses decline by a pretty remarkable 26%.
Which represents a $4.5 million reduction, roughly. 4,528,000 in Q3 2025 compared to Q3 2024. That's a huge cut in a single year.
And it wasn't just a one-quarter fluke. For the first 9 months of 2025, operating expenses were down a full 20%.
Or $10.239 million. So this demonstrates real, measurable, and sustained operational discipline.
It does, but we have to interrogate this a little, right? Because sometimes efficiency comes at a cost to future growth. So where did the cuts actually occur?
That's the right question. The sources break it down. General and administrative expenses fell 27%, and that's the healthy kind of streamlining. It came from reductions in payroll, bad debt, and professional fees.
Okay, that makes sense. Trimming the fat.
Right. But let's look at research and development expenses. R&D decreased 23%, and the filing specifically cites a massive $1 million decrease in payroll costs there.
Oof. $1 million cut to R&D payroll. That's the friction point, isn't it?
It is. I mean, given that this company lives and dies by its AI and software differentiation, you have to ask, are they cannibalizing their future innovation to manage the current burn rate?
That's a very fair challenge. So what was management's framing of this?
Well, the sources suggest management framed these cuts not as, eliminating projects, but as optimization. They argued they've achieved new efficiencies by leveraging better internal development tools and focusing R&D efforts more tightly on their commercialized platforms, like Rekor One.
So strategic streamlining to align their cost structure with their current operational reality.
That's the idea. The goal being efficiency gains without hamstringing the core AI engine.
Yep.
But you are right. It's exactly the kind of cut you make when you know your cash runway is short and every single penny counts.
And when you combine that record revenue, the soaring margins, and the tight cost control, the result is maybe the most compelling figure in the entire 10Q filing, the adjusted EBITDA loss.
This is the bottom line of the operational story. The loss narrowed significantly to negative $1.459 million in Q3 2025, just under $1.5 million.
And management themselves characterize this as the best in company's history.
To really appreciate the scale of that improvement, you have to contrast it against the loss just 1 year earlier. In Q3 2024, they lost negative $9,407,000.
So a loss of over $9 million a year ago, down to under $1.5 million now.
Exactly. We're talking about an operational improvement of nearly $8 million in a single year. That's massive.
That narrowing demonstrates what you called real operating leverage. It proves the Darsha's model is yielding efficiency gains much, much faster than the old project model ever did.
And it moves them tantalizingly close to that break-even point. It signals that if they can continue securing these large, high-margin DaaS contracts like the GDOT deal, they could flip to being cash flow positive much faster than analysts previously modeled.
Okay, let's conclude this financial section by discussing what seems to be a huge signal of internal confidence, which is tied directly to that cash management challenge, the decision to terminate their equity issuance program.
Right, the ATM. Historically, the company used an at-market issuance sales agreement, which, allowed them to sell shares directly into the market to raise cash whenever they needed it.
A financial lifeline, essentially. How much have they used it?
It provided net cash of about $22.3 million, $22,350,000 through Q3 of 2025. But then, in August 2025, they voluntarily terminated that ATM agreement.
Okay, so an ATM is, like you said, a quick, easy safety net for companies that need liquidity, but it always comes at the cost of continuous shareholder dilution. So why is voluntarily terminating that safety net such a strong signal to the market?
Because management is taking away their own immediate financial crutch. By shutting down the ATM, they're signaling two really important things.
Okay, what's the first one?
First, they believe they have adequate confidence in their future cash flow projections, specifically the high margin revenue they anticipate from contracts like GDOT to fund their operations going forward.
And a second.
Second, they're basically stating that they do not want to endure aggressive shareholder dilution at the current stock prices. They think the stock is undervalued. It's a highly calculated, very aggressive bet on their near-term commercial execution and the speed with which that day revenue is going to start flowing.
It shows they're acutely aware of that going concern warning and believe they have the commercial solution already in hand.
They're betting the farm on it.
We have to talk about that going concern warning explicitly because this is the structural risk that underpins everything else we've discussed. It's a federally mandated disclosure right there in the Q3 2025 SEC filing that states there is substantial doubt regarding the company's ability to continue as a going concern.
We can't gloss over this. It is critical.
So for the listener who hasn't encountered this before, what exactly does this mean in practical terms and why is it so severe?
This is the market's blinking red light. It means that, according to standard accounting procedures, current management has formally assessed that their existing cash resources are deemed insufficient to fund their current level of operations for the next 12 months.
The next 12 months. So without new money or a big change.
Without securing external financing or executing a major commercial event, they run into trouble. And this disclosure has real-world consequences. It increases your borrowing costs, it complicates vendor relationships, and it can seriously impact your ability to negotiate new capital on favorable terms.
So the company is openly stating they will run out of cash within the year if things don't change dramatically.
Exactly. And that is why that operational pivot, the 63.4% margin in the GDOT contract, is not just some upside catalyst. It is an existential necessity.
Management is betting that the speed of DaaS contract fulfillment and the high margin of that revenue will bridge the gap to profitability before the cash clock runs out.
And that ATM termination is their high confidence signal to the market that they believe that bridge is already built.
That brings us perfectly to the technology that underpins this entire shift. If the financials are the reason they must change, the technology is the reason they believe they can't change. Let's move to our second section and look at the core products and the AI integration that creates their technological moat.
Okay. At the heart of everything they do is the foundational AI engine, REKR 1.
And what is REKor 1, really?
You can think of it as a highly sophisticated computer vision platform that's designed to build what they call the digital operating system for our roads.
Yep.
It aggregates and transforms raw mobility data into actionable intelligence.
The technological edge here seems to be multifaceted. The first one is that the AI is camera agnostic.
That is a massive scalability advantage. It means it works with nearly any existing IP camera infrastructure out there. A city or a state doesn't need to rip and replace all their old cameras. Rekor just needs to integrate their software. It saves millions in upfront hardware costs for the client.
And the level of insight they provide, it goes well beyond just, reading license plates.
Oh, absolutely. Beyond simple license plate recognition, or LPR, their platform provides deep vehicle recognition. We're talking make, model, color, body type, and the ability to track behavioral patterns.
And that level of granular detail is critical for what? Both public safety and planning. Exactly. For public safety, a witness might only remember the color and make of a getaway car. For infrastructure planning, understanding the precise classification and volume of vehicles is paramount for road maintenance and funding.
And the second big technological differentiator, which I think is fascinating and frankly necessary for a DaaS model deployed statewide, is their reliance on edge processing. Can you explain the role of edge processing as a key technical moat here? Because that's what makes this real-time DaaS model scalable over vast distances.
This is the physics problem of infrastructure data, and edge processing is their really elegant solution. Think about a high-resolution video stream. It's a continuous fire hose of data.
Huge files.
Huge. If you try to send that raw video over standard network lines for centralized processing, you immediately hit massive bandwidth bottlenecks and crippling latency, especially in rural areas where connectivity is spotty.
So edge processing solves this by putting the AI analysis where?
On the pole, right where the data is collected. The hardware does the analysis on device. So instead of trying to send a massive video file, say a 50 megabyte clip back to a central server every second, what are they actually sending over the network?
This is the key. They are analyzing that high-res video stream right there on the device, and they're converting the raw video into lightweight, compressed metadata. It's essentially a few kilobytes of text data.
Text data that's just reporting what it sees.
Exactly. It's simply reporting, at this time, vehicle X, which is a red Ford pickup, crossed this line traveling 45 miles per hour. And that tiny packet of text is all that gets sent,
And this process dramatically slashes network bandwidth needs and latency.
which enables real-time insights at scale. It's essential for things like incident detection, where milliseconds truly matter. This ability to process locally is a huge differentiator when you're dealing with vast state or nationwide deployments, and it makes their DaaS offering efficient and robust.
Let's organize the applications of this core technology into the 3 core pillars of revenue the company operates under. Let's start with urban mobility, which is handled by their Discover platform.
Right. Discover focuses squarely on highly accurate DAISY's vehicle analytics for things like traffic studies, infrastructure planning, and even estimating emissions. This is the product that is directly targeted at replacing archaic and, honestly, dangerous methods used by state DOTs.
You mean like those old pneumatic rubber tubes they stretch across the road?
Exactly those. Or manual human counters with clickers on the side of the highway.
Yeah.
Discover is a pure data subscription service that automates and improves all of that.
And what makes Discover truly indispensable for government clients is that it delivers the federally mandated FHWA 13-bin classification data. We touched on this, but we need to really explain why that specific technical standard is such a high barrier to entry for competitors.
It is the absolute gatekeeper to federal money. The Federal Highway Administration, the FHWA, uses this precise 13-bin standard to categorize every vehicle by type, weight, and number of axles.
Everything from a motorcycle up to a big rig.
Everything from motorcycles, which are bin 1, all the way up through 5-axle or 7-axle truck combinations, which are bins 9 through 13.
And if a state DOT is applying for federal infrastructure funds, which, let's face it, often cover the vast majority of major road projects, their data has to meet this standard.
It has to. Their traffic and pavement-wear data must be classified accurately according to the 13-bin standard. If the data doesn't meet that standard, the state simply doesn't get its federal money.
It's a non-negotiable compliance requirement.
It is. And legacy methods are notoriously inaccurate, which often leads to underreporting of true heavy truck traffic. That messes up pavement design formulas and, critically, it impacts their federal funding eligibility.
So Discover uses AI vision to classify these vehicles non-intrusively and accurately, fulfilling this critical regulated compliance need.
While simultaneously improving safety by taking human workers out of harm's way on the roadside, that compliance mandate is a huge technical and business moat.
Okay, moving to the second pillar, Command for Transportation Management. You describe this as the real-time brain for traffic management centers, or TMCs.
Yeah, Command is all about fusing information to create real-time operational awareness. It ingests data not just from Rekor's own cameras, but also from connected vehicles, third-party sensors, navigation apps like Waze.
It's an aggregator.
It's an aggregator and an analyzer. It fuses all that multi-source data for rapid incident detection and response. It moves the TMC from a reactive system, where they wait for 911 calls about crashes, to a proactive system that can detect an incident within seconds of it occurring. This is the platform that's central to those massive TXDOT contracts we'll discuss in a bit.
And finally, the third pillar, Scouty for Public Safety, which addresses law enforcement needs.
Right. Scout provides that AI-driven LPR and deep vehicle recognition for law enforcement agencies. The focus here is on leveraging the AI's deep classification capabilities.
So police can search their data not just by a known license plate,
but by make, model, color, and even directional travel. That's a game changer when you're working off a partial witness description in a high-stakes situation like an Amber Alert or tracking a suspect's vehicle.
and the impact is measurable.
It's immediate and measurable. We saw specific results cited from Mount Juliet, Tennessee, where deployments reported up to a 48% decrease in crime in covered areas, primarily by disrupting the ability of criminals to use the roadways anonymously.
Before we move on to the commercial proof of these platforms, we have to dedicate some time to this new strategic initiative, the post-Q3 development of Rekor Labs. This is a move well outside their core roadway sector. They're going into deepfake detection.
It's a fascinating development, and it's generated a lot of excitement. What's so interesting here is how the company is beginning to realize the value of its underlying AI expertise beyond its core infrastructure market.
And this didn't just come out of nowhere, right?
No, the genesis of Rekor Labs came from specific government customer requests.
Right.
Customers who are already relying on Rekor to verify the integrity of their federally mandated traffic data videos started asking a very logical question.
Which was?
If your AI can detect and classify a vehicle flawlessly, can it apply that same machine vision expertise to detect if a video itself has been tampered with or synthetically created?
So they're leveraging their foundational IP into a massive adjacent market.
Exactly. Rekor Labs aims to address the rapidly growing threat of generative AI being used to create fraudulent video evidence or manipulate public information. The core competency is still machine vision, but the application shifts from recognizing vehicles to verifying the authenticity of pixels.
And the market for this is huge.
It's massive. The market opportunity for this side venture is estimated to surpass $30 billion in the next decade. It covers everything from verification of evidence in court to enterprise-level media security.
And the fact that they've engaged Moelis & Company as a financial advisor to explore the corporate structure for this new entity, that suggests management is pretty serious about unlocking the valuation potential of this high-margin, pure software IP.
It does. They might be looking at spin-off or a separate capital raise. And if we connect this to the broader picture, the creation of Rekor Labs is seen as a blue sky catalyst for investors.
How so?
It demonstrates that the company's innovation is generating new, valuable, pure software IP beyond its core market. This is the kind of asset that venture capitalists and institutional investors absolutely crave.
And it only amplifies that valuation arbitrage discussion we were having, offering a potential path to monetize assets without diluting the core REKR business structure too heavily.
Right. It's a huge indicator that their technology moat is much wider than just asphalt and traffic cones.
Okay, let's pivot hard back to that core business and look at Section 3, commercial proof and the scalability blueprint. Because all those record Q3 numbers we talked about, they happened before the market fully internalized the significance of the GDOT contract, which was secured post-Q3.
And this contract is the absolute cornerstone of the entire investment thesis.
The Georgia DOT, or GDOT, contract is the definitive validation of the DaaS model for state governments, right? And it provides the blueprint for national scalability.
It's REKR's largest statewide contract to date, and it's structured in a way that minimizes administrative friction for both parties, which is key.
Let's detail the financial significance first. We're talking about a minimum guaranteed contract value of $50 million over a potential 7-year term,
with the potential total value reaching up to $100 million if all the extensions and options are fully utilized.
Yeah.
But as you noted, the dollar amount isn't even the most important part. It's the cooperative purchasing mechanism.
Explain that, because that's the strategic key to unlocking expansion.
It is. In government sales, the biggest impediment, the biggest roadblock, is almost always the procurement cycle. Every city, every county, every regional authority. They typically need to run their own competitive bid process, which can take years and requires massive administrative resources.
So how does this GDOT mechanism bypass that bureaucratic hurdle?
The cooperative purchasing terms allow other Georgia government entities, cities like Atlanta, all the different counties' regional planning groups, to adopt the exact same DaaS solution at the pre-negotiated statewide price without needing to run separate competitive bids.
So GDOT did the hard work for everyone.
Essentially, yes. They did the competitive bidding and the vendor vetting on behalf of the entire state's infrastructure ecosystem.
And this dramatically speeds up local adoption from what would normally be, say, a 2-year sales cycle
to potentially just a few weeks of administrative sign-off. This single contract has essentially pre-qualified Rekor for every major local and regional agency in the entire state of Georgia.
That is massive for sales cycle efficiency and for future revenue predictability. And the contract structure, it seems to validate the core DaaS value proposition perfectly, going beyond just data collection.
It does. GDOT themselves confirmed that the DaaS approach largely eliminated administrative overhead. All the headaches associated with managing device inventories, warranties, maintenance, invoice validation for thousands of count sites.
That's all on Rekor now.
It is. The state is relieved of the burden of being an IT hardware manager. They just pay a predictable subscription fee for the data stream, and Rekor handles the infrastructure end-to-end. For the DOT, that translates directly into cost savings and staff reallocation.
Now, the GDOT win didn't just happen in a vacuum. It really built on the momentum that was established in another massive infrastructure state, Texas, with the Texas DOT, or TXDOT, multi-year statewide contract.
Right. The TXEOT contract is the critical validation for their Commandy platform, proving its ability to manage these large, complex incident response operations.
Hmm.
It included an 8-figure blanket purchase order for Rekor Commandy, which allows for deployment flexibility across all 25 TXDOT districts.
And the significance here lies in the measurable, quantifiable public safety results that the platform delivered.
Exactly. Let's talk numbers. The results achieved in the Central Texas Regional Mobility Authority, or CTRMA, are pretty staggering. They saw a massive 324% increase in incident detection,
324%.
and they managed to cut the average response time by 11 minutes.
If you think about the bigger picture, an 11-minute faster response time for a crash on a major highway is, that's potentially life-saving.
It's life-saving, and it's certainly traffic clearing. Reducing clearance time is the single most important factor in reducing congestion and, critically, secondary accidents.
And they have data on that too, right?
They do. The TXDOT Austin District measured an 8.4-minute faster median detection time, and the data show this resulted in a 29% reduction in secondary crashes, those often severe accidents caused by the backups from the initial event.
And government agencies don't renew 8-figure purchase orders unless they see that kind of hard return on investment.
No, they don't. It completely validates the high-margin data's fee structure they're charging.
So beyond the traditional DOT traffic management, there's also this truly innovative compliance model they pioneered in Oklahoma, the Auto Noticer program. This uses the Scout platform's capabilities for contactless compliance.
This model is so clever. It addresses the major social problem of uninsured vehicles. When a vehicle is identified without required insurance, the state issues a diversion notice. It gives the driver a chance to get insured before they face the full penalties.
And the statistic on its effectiveness is striking.
It really is. The program cut the number of uninsured vehicles in Oklahoma from over 350,000 down to under 200,000. It's a remarkable improvement in public safety and compliance, all achieved through non-intrusive technology.
And the revenue structure is fascinating. You mentioned it's a powerful selling point to other cash-strapped states because it is revenue neutral. How does that work?
That's the genius of the model. Rekor receives a fixed fee. It's $43.50 in Oklahoma for each successful diversion notice. And they also get a commission cut, averaging around $120 from the new insurance policy the driver purchases.
So the program pays for itself.
Exactly, because the fees and commissions generated by new policy purchases cover the technology and the operational costs. The model is revenue neutral for the state. It's funded by the violators, meaning the state doesn't have to budget for the technology up front or use taxpayers' dollars.
Which makes it incredibly easy to sell, both politically and administratively.
And that demonstrates significant expansion potential for them across that whole public safety pillar.
Okay, let's transition to our fourth section, beyond DOTs, and focus on the wider commercial applications, because this core AI has applications that extend far beyond government contracts. Let's start with a surprisingly consumer-facing application, pay-by-plate.
This partnership really highlights the versatility and marketability of their core AI. We see them partnering with MasterCard at White Castle, piloting pay-by-plate touchless e-commerce at the drive-thru.
How does that work exactly?
It's pretty simple. The camera recognizes your vehicle, links it to your pre-registered customer account or app, and streamlines the ordering and payment as soon as you pull up to the window. No fumbling for a wallet or a phone.
The efficiency gain is subtle, but it must be powerful in a high-volume fast food environment.
It is. It saves just a few seconds per car. But you multiply that across thousands of locations and millions of transactions, and it adds up to massive operational savings. It speeds up throughput, and it improves the customer experience.
And you see this frictionless application applied elsewhere to create these recurring subscription streams.
All over the place. Subscriber recognition at car wash facilities, streamlining payments in private parking lots by automating entry and exit, and fleet management for rental car companies or large logistics operations.
Every single application leverages the same foundational AI engine to remove friction from the physical world.
It turns a vehicle's appearance into an instant transaction trigger.
Okay, let's bring it all back to the money, because this operational shift feeds directly into the core investment thesis, what we're calling the DaaS valuation arbitrage.
This is it. This is the whole reason analysts talk about price targets that are wildly disconnected from the current share price. And it's why that 63.4% margin is so incredibly important.
Explain this. This is the fundamental premise of the bull case, and it hinges entirely on revenue quality.
Right. The market fundamentally values different revenue streams
Yeah.
differently. Legacy project revenue, which
Yeah.
is volatile, low margin. Remember, it dipped to 49.5% and it's non-recurring. That kind of revenue commands a very low revenue multiple.
It's typical.
Historically, infrastructure and hardware installers might be valued at a low revenue multiple, maybe 2x to 3x their annual sales.
So if they were valued at 3x revenue on, say, a $50 million run rate, the enterprise value would only be about $150 million. But the DaaS model completely changes that calculation.
Precisely. Predictable, recurring, high-margin DIS revenue like the 63.4% they achieved in Q3 is considered higher quality income. It's sticky, it's easier to forecast, and it's highly scalable.
And because of that predictability and high profitability potential, it commands significantly higher software multiples.
Much higher, potentially a 5x to 15x multiple, sometimes even higher for a high-growth AI firm.
That is an exponential effect. So if Rekor successfully executes this shift and they convert, say, $10 million of volatile project revenue into $10 million of sticky DaaS revenue.
The company's valuation doesn't just increase linearly, it compounds based on that multiple expansion. And that's what justifies the aggressive bull cases and price targets like $4 per share that you see out there.
It creates a market arbitrage.
Exactly. Investors are buying a company that's currently valued like a hardware installer with low margins and a major liquidity problem, and they're hoping that management can transform it into a high-growth software and data services firm that commands those high multiples.
And the operational execution in Q3, combined with that GDOT contract, is the definitive proof point that this transformation is actively underway.
It's happening in real time.
However, we do need to briefly touch on the outstanding legal proceedings that could still impact their cash flow or structure, specifically because the company's liquidity is already the central risk. We need to look at the lawsuit from H.C. Wainwright & Co.
Yeah, the HCW lawsuit is a significant litigation risk that directly impacts their tight cash position. HCW is suing Rekor for breach of contract, and they're seeking at least $825,000 in cash, plus warrants.
What's the allegation?
They allege Rekor breached its right of first refusal, or ROFR, related to a July 2023 transaction, and they're also seeking an additional amount related to a 2024 public offering.
Now, Rekor did settle its counterclaims against another entity, Armistice Capital, in Q3, but what's their position on the HCW claims?
They state that they believe the HCW claims are without merit, and that they intend to defend themselves vigorously.
But regardless of the merit of the case, litigation is expensive, and it comes at the absolute worst possible time for a company that's facing a going concern warning.
That is the core concern here. The sources explicitly state the company faces liquidity risk. Litigation costs, even for a successful defense, are a constant drain on that precious cash runway. It could potentially slow their timeline for achieving profitability from those big DaaS contracts.
It's just an unwanted frictional cost against their primary goal, which has to be maximizing cash flow generation.
Absolutely.
On a slightly brighter note regarding legal issues, we should probably mention the positive ruling on the OSHA claim in Q3 2025.
Yes, that was a good development for them. An administrative law judge ruled in Rekor's favor and dismissed the complaint filed by former employees related to an OSHA claim.
So that's a favorable outcome. It reduces a potential liability exposure.
It does, but we have to note that the claimant has requested an appellate review. So the issue isn't 100% resolved, and it may still incur future administrative costs. The legal landscape just remains complicated by these residual issues.
Okay, let's bring this deep dive to a comprehensive close with our final synthesis and verdict. We need to weigh the proven operational execution against that very real structural financial risk. Let's clearly define the bull case and the bear case one last time.
Okay. The bull case rests squarely on the operational success of this strategic pivot. The record Q3 operational metrics, that massive 35% revenue growth, the soaring 63.4% adjusted gross margin, the aggressive 26% cut in operating expenses, and the resulting narrowing of the adjusted EBITDA loss to under $1.5 million.
That all provides an undeniable foundation for the DaaS transition thesis.
It does. And critically, that $50 million GDOT DaaS Blueprint, with its cooperative purchasing terms, proves the scalability model works for massive state government clients. And, maybe more importantly, it solves that procurement challenge.
But the shadow hanging over all this success is the structural bear case, that severe liquidity crisis. We have to review the history of negative operating cash flow. It stood at a stark negative $20.582 million year to date for the 9 months ended September 30, 2025.
Over $20 million of cash burn in 9 months. It's massive.
And that cash burn is the direct cause of that explicitly disclosed, federally mandated warning of substantial doubt regarding the company's ability to continue as a going concern. That's in the Q3 SEC filing.
It is. Their existing cash is deemed insufficient to fund operations for the next 12 months without immediate external financing or immediate commercial success. The entire investment hinges on whether the speed and margin of the GDOT contract and subsequent DaaS wins can reverse that negative operating cash flow fast enough.
So what does this all mean for you, the listener?
I think the final question is whether the operational and commercial successes are sufficient to bridge the company to sustainable profitability and overcome those severe liquidity concerns, especially considering they still face competition from a fragmented field of legacy providers who are relying on slow, one-off sales.
It really raises an important question of timing and flawless execution. Can management execute flawlessly on that GDOT contract, translating that paper promise into high-margin cash flow fast enough to eliminate the going concern risk?
The pivot is validated.
The pivot is validated, the margins prove the model works, but the cash runway is dangerously short. Investors are essentially betting that the speed of DaaS revenue adoption and the resulting valuation arbitrage will outrun the burn rate that's been created by scaling this entire business.
It's the tightest of tightrope walks.
Where commercial execution is the only lifeline. And maybe a final provocative thought for you to explore on your own, one that builds on this central tension. We've highlighted the need for agile, subscription-based AI services, like Rekor's DaaS model, to modernize our infrastructure. But the reality is that government procurement policies are still overwhelmingly built around slow, one-off capital projects, buying a piece of hardware that lasts 10 years.
Right, the old way of doing things.
So if the biggest roadblock to smarter roads is not the technology, but the entrenched bureaucracy designed to buy old hardware, how do state agencies fundamentally change their spending structures and their risk tolerance to successfully embrace high-margin DaaS companies like Rekor?
A fascinating problem of policy meeting technology, and one that really determines who wins the race to modernize our infrastructure.
Absolutely. That concludes our deep dive into Rekor Systems, Inc.
Risk defined, portfolio protected,